In this video, I'm going to explain everything that I wish I knew before I started trading stock options. So I got introduced to stock options when I was going through a pretty rough time financially. I had graduated from school, I didn't have the best job, and I needed to turn a little bit of money into a lot of money. So I tried different forms of investing, trading big board stocks, mid-cap stocks, and things like that, but they didn't give me the kind of return that I was looking for because I didn't have a lot of money until I got introduced to stock options. I was seeing people in different trading groups and message boards, shout out to Investors Hub, and they were making a lot of money from small amounts of money. I mean, I was seeing people make 5 to 20x on their money. So some quick math told me if I had $200 and I could get that times 20, 200 to 4,000, that's the kind of trading I wanted to be involved with. But I had no idea what I was getting myself into. And I wish I had the information in this video back then before I got started. So let's go ahead and get this out the way, the boring definition of what a stock option is. Stock options are a type of investment that gives you the right, but not the obligation, to buy or sell a specific stock at a specific price. And that specific price is called the strike price. So if you buy some Apple options, let's say you have a strike of $170 and they expire in 2 weeks. If the Apple stock gets above $170, then you can exercise your option and buy the stock at that 170 price, even though the market price may be higher than that. By doing this, you have an immediate profit between that 170 price that you bought it at and the current price of that stock. But honestly, when it comes to trading stock options, many people don't take this route, and I'll explain why later in the video. Now, there are two types of options. You have call options and you have put options. A call option gives you the right to buy shares of a stock at a certain price, and a put option gives you the right to sell shares of a stock at a certain price. So if you want the stock or expect the stock to go up, you will buy a call option. If you expect or want the stock to go down, you will buy a put option. Now, the reason options trading attracts a lot of people is because of the volatility. If you've ever taken the time to watch the stock market or even just watch a particular stock throughout the day, you can see just how quickly stocks move by themselves. So as the price of the stock moves up and down, so does the price of the stock options. They move up and down also. So think about shares of Apple stock being like a cup of coffee, and think about Apple options being like an espresso shot. It's the same company, it's the same product, but a totally different type of investment with different levels of potency. And this is how you see people that turn a small amount of money into a large amount of money by trading options instead of trading the underlying stock. Now, this all sounds good, right? You take a few $100s and you become rich in 6 months? Sounds great to me. But there are some things that I wish I understood better, and it starts with the Greeks. Now, the Greeks are particular measurements that make up the price of stock options. You have the delta, which measures the rate of change in the price of an option relative to the changes in the price of the stock that is derived from. So if the delta is high, generally that means that the stock option will move up and down at an aggressive rate, compared to an option with a smaller delta that may not move up and down as aggressively. Now, a good way to visualize delta is to think about a racetrack. The tires of the car represent the delta, and the gas pedal represents the underlying stock. So low delta options are like race cars with economy tires. They won't pick up a lot of traction and gain a lot of acceleration, even though you may be slamming the gas pedal. On the other hand, high delta options are like drag racing tires. They provide a lot of traction if you just tap the gas pedal. So even a slight acceleration in the underlying stock means that the option is going to make an even further jump. Then you have gamma. Gamma is the rate of change in the delta as the price of the underlying asset changes. So the gamma and the delta are very closely related. For example, let's say you have two options that have the same delta, but one has a higher gamma. The option with the higher gamma will carry more risk, since a negative move in the underlying stock will create an exaggerated impact on the stock option. So high gamma values mean that the option has very volatile swings, which means the option can be pretty hard to make a strategy around if it's so unpredictable. Then you have Vega. Vega measures the sensitivity of an option's price to changes in the implied volatility of the underlying stock. So Vega is important because it helps you to understand how changes in the overall market conditions can impact the option itself. Now, the fourth Greek, the final boss, and the one that I wish I fully understood before I started getting to the options, and that's theta. Theta measures the rate of decline in the option's price, also known as time decay. As time passes, the price of the option will decrease if it doesn't seem likely that you'll hit your strike price. And time decay tends to accelerate the closer you get to expiration date. So for example, let's say I bought an option on Monday, I will have to hit my strike price by Friday. Monday and Tuesday could be going very well. By around Wednesday, if I'm not getting close to my strike price, the price of that option starts to decline extremely fast. And this is why theta is important. So when you compare options to things like index funds and ETFs and stocks, you have many more things that you need to consider when it comes to making a profitable trade. With other investments, you don't really have to worry about timing. If I like an index fund, I can make my contributions at a consistent rate, just sit back and watch it grow over time. But that does not work in in options. Overall, timing is probably the most important aspect when it comes to trading options, and you have to be very keen to this. You have to think about your expiration date, you have to think about the underlying stock, the volatility of the underlying stock, and also market conditions to even see if this is a good time for you to place a trade or not. Now, a lot of stocks pretty much mimic what happens in the S&P 500 or the SPY as the ETF. If the SPY is doing well, then you have a good chance of the stock and the option that you're invested in to be doing well also. But if the SPY is doing bad, if it's declining, then you can expect the same in your options. Now, the worst case scenario is when the SPY is not trending up or trending down, and it's kind of just trading within a channel. And this is when trading options becomes extremely dangerous. If there's no trend in the market, then there's no trend in your options. So if your options are not moving up and down, then you will start to feel the impact of theta a lot quicker than you probably would when the market is trending. So there were times when I was trying to make money in options when the market was just in a channel for maybe 2 to 3 months, and my money would just be declining and declining because the option isn't moving anywhere, but that theta, that clock, and that time decay, it keeps ticking no matter what's going on. So this is the approach that I would take now if I was to start over trading options. The first thing I would do is I would pick 1 to 3 companies that I'm familiar with and at least have some type of decent movement in the stock. It's important to pick between 1 to 3 because each company, each stock, and their options all have different personalities. So if you start out by trading many different companies at once, you won't really be able to start picking up on any patterns because you're learning all of these different movements and personalities at the same time. Some of the best traders that I know, they have a bucket of maybe 10 to 15 stocks max that they trade, and those are the only ones that they trade. So since they know these companies very well, they know when it's the right time to trade an option for a particular company, and they know when the time is not right. They can tell you what's going on with the company, what's going on with the market itself. They can describe how the options trade. I mean, they have mastered all of these companies over time. Now, when it comes to the actual trading, I would start out with paper trading first. Paper trading is basically simulated trading without the risk of using real money. It involves using a simulated account, but you can still have the same tools available to you so you can try different strategies and just kind of learn how everything works. But the thing about paper trading is I wouldn't spend too much time on it. I would maybe spend a month, maybe 2 months max to understand just how things work, but I would try to get away from paper trading at a decent time because paper trading removes a big aspect of trading, which is your emotions. You haven't really traded anything until you start using your real money, because then you have the fear of losing money and then you have the greed of trying to make more money, and that impacts your decisions every time. So once I got done with my time of paper trading, I would save up maybe $500 or so. I would take $50 and try to put on 10 trades, not all at the same time, but 10 trades in total. Now the goal for these 10 trades is not for you to really make money. You just want to get used to actually using your real money and seeing how an actual real life trade is going to make you feel, and the strategies that you've been trying to learn, if they're going to work for you or not. If you make money on this $500, then that's great. But if you lose money on this $500, don't be surprised. This is something that we call market tuition. Unfortunately, the only way to really learn trading is you have to lose some money at some point. It happens to everybody. Once I was able to get past this point of the 500, if I was able to save up another 500, then I would try to stick to one particular strategy that I started to see was working for me at my first go around. I would try to replicate this strategy as many times as I can so I can see what type of trader I really am. But the goal is to be able to replicate the same strategy over and over time. Now, options trading can be very rewarding and very lucrative if you have the right mindset and if you put into practice. But you can't start options trading if you don't have any money saved up. So watch this next video about how to save you $1,000 so you can get started on trading options and doing other types of investing.